According to supply managers in the 9 Mid-America states, how is the economy performing?
Our survey of supply managers, manufacturing supply managers in 9 states, stretching from North Dakota, Minnesota, and north to Oklahoma and Arkansas in the south, the overall reading was jumped significantly up, still in a slow growth range, up to April 54.8, and that's up from March's slightly above growth neutral 50.8. So it was a good reading, still not back up to the readings we saw at this time last year. That was April of 2022, but still is a good reading. The national number will come out later on this morning. I expect it to be up slightly, but it's going to be below growth neutral, so that's what we're seeing. And this week, the Bureau of Economic Analysis announced their GDP growth for quarter one, which was 1.1%. That's not good. In other words, this economy is slowing down even with our, I'll call it positive readings for the month of April. We asked the survey participants about the probability of a recession according to supply managers and manufacturing supply managers, 58.7, so still above 50%. So most of them thinking of recessions in the cards for looking ahead for 2023. Now here I'll bring up a graph showing, comparing and profiling the U.S. number, which is in red there, you'll see, and in the blue one, in beautiful Creighton blue, you'll see the reading for the Mid-American region. You see there 54.8, and you see last year, as you see at this time, April was 65.9. So even though it's up for the month, it's well down from this time last year. So the overall economy is slowing down. The growth is slowing down, but it's still positive. That's what we're seeing for the Mid-American region for the month of April.
What were the hiring trends?
Hiring for April was weak, but still above growth neutral. The number for April was 52.2, and that's up from March's 50.0. And again, these numbers range from 0 to 100, with 50 being growth neutral. 47.8% report that they have an adequate number of applicants for job openings. So that's a pretty good number and still below 50%. We're still seeing labor hoarding out there, I'll call it, because companies really are attempting to not let loose the workers. They don't want to let them go. They're knowing full well they may not ever get them back. So in some cases, we're seeing workers not being fully busy at their jobs, so that's bringing down productivity. And when we saw in terms of job gains for the region, we're talking about annualized over the last 3 months, Mid-America 1.9%, and that's pretty darn good, but that's compared to the U.S.'s 2.7%. So the point here is job growth remains pretty solid even as the economy is weak. Now what does that mean? Productivity. Productivity is just not good out there right now.
What inflation trends are you noticing?
Inflation gauge dropped. It's down from March's 77.1 down to April's 67.4, and that's the lowest reading since December of 2022. So we're seeing less and less inflationary pressures. Now, we do see up and down numbers on the inflation gauge, but when you look at the trend, it's definitely down. Inflationary pressures are coming down as the Federal Reserve is raising interest rates, and that is putting downward pressure on prices. When you look at the CPI, the 3-month number is 1%. Now that's 3 months, of course. That's still above the growth, what the Fed's target is. When you look at the PPI, that's the Producer Price Index, 0%. That's the Wholesale Price Index, the last 3 months, and that's 3 months there, 0%. Obviously, we're seeing less and less inflationary pressure at the wholesale level.
What is the economic outlook?
Outlook, I'll call it again, and we did this to call it last time. I call it last time, is a rolling recession. By that I mean we're seeing recessions in certain parts of the nation, but more in certain industries. Residential housing, still I'll call it in a recession simply because the inventory is just not there. Construction labor is not available, so that's slowing. That's I'll call that a recession. Commercial real estate, definitely in a recession. We're seeing excess real estate in the commercial area, and that's downtowns principally, where you're just seeing a lot of open space there. And then finally, banking and finance definitely in a downturn. That we're seeing, of course, First Republic probably going to be in big trouble. We'll see that this weekend, maybe this weekend. Well, it'll be probably the following weekend. Right now, the First Republic is having some real difficulties in terms, and they may fail. We may see insolvency there. So, and looking ahead, the CPI, I think it will continue to come down. We're probably going to see 0.3% for the month of April. Now, that's still above the Fed's target of 2% annualized, or 2% annual. The Federal Reserve will raise interest rates, and they meet again on the 2nd and 3rd of May. They will raise rates on May the 3rd unless we see some unusual activity coming out of First Republic. Now, that would be an insolvency. That could put the Fed on the sidelines, but I fully expect a 0.25%, 25 basis points hike then. Short-term interest rates will thus increase by 0.25%, 25 basis points. So on May the 4th, look for your prime interest rate to go from 8 to 8.25%. That's getting a little high there for the borrowers. The Fed meets again on June the 13th and 14th. I don't expect a rate hike then. I think there are too many negative signals right now in the economy. I think the Fed's going to pull back in June. Not a rate cut now. There is no rate cut. That language should be X'd out right now. There's no rate cut from the Federal Reserve. Prime interest rate, as I said, will rise from 8 to 8.25. Long-term interest rates, they're going to move, I think, sideways up a bit as the Federal Reserve reduces its balance sheet. That's putting up some upward pressure on long-term interest rates, but not much because, again, that outlook is the long-term outlook for inflation, which is still not bad looking long-term. But keep an eye on the bond market. That's what you need to watch out for, especially in terms of the 10-year Treasury. Mortgage rates are tied to that 10-year Treasury, and that rate's moved up and down. Almost, we moved up to 4%. Now we moved back down to about 3.5%, and we moved down to 3.25%. It's moving in that range, and that's just telling you the probabilities of a recession as it moves lower, and inflation as it moves higher. So telling you a lot about what's going on out there. Keep an eye again on the 10-year Treasury, and moving up to 4% would tell you that the probabilities of recession are coming down, but the probabilities of higher inflation are going up. So, but I expect it to be in the low 3 to 3.5, 3.4%. That's indicating slowdown in the overall U.S. economy. Keep an eye on, of course, the national ISM reading for April, which will come out later on this morning. I expect it to be up for the month, but still below growth neutral. Price of a barrel of oil, if it moves above $80 a barrel up towards, especially moving up to $90 a barrel, that's going to be problematic, of course, to the Federal Reserve and for consumers out there. And again, listen carefully to what Jay Powell, the head of the Federal Reserve, says in his press conference on May the 3rd. He'll be telegraphing what the Fed is going to do and where they stand in terms of the, I won't call it a crisis in banking, but some of the issues in banking, but also in inflation. So that's going to be important. And listen to the governors of the Federal Reserve and the presidents of the Federal Reserve banks as they talk about what's going on there and what they're going to do in terms of interest rates and inflation. But that's it for the month of April. It was a reasonably good reading. Again, looking ahead, it's pointing to slow growth, but positive growth. Inflationary pressure is still up higher than the Federal Reserve would like. But again, it's moving in the right direction for the Federal Reserve, slower inflationary pressures. Until we meet again on the first business day of the month of June, may your economic cup runneth over. And Ernie Goss here from Creighton University in beautiful downtown Omaha, Nebraska.